This is a dramatized story inspired by real debt situations. For educational and entertainment purposes only. Not legal or financial advice.
Section 1. Hook. 30. The mortgage was $2,147 a month. I was 4 payments behind. That's $1,138 I didn't have, and the bank had already sent the notice. At 44 years old, I was a construction foreman with 17 years on the job. I had calluses on my hands and a hard hat on my wall, and a foreclosure letter on my kitchen table. What happened over the next 6 months, and the one phone call that changed the outcome, that's what this story is about. Section 2. Reality. 34 sush. Let me back up and give you the real numbers, because that's the only way this makes sense. My name is Marcus Webb. I'm 44, and I've been in construction my whole adult life. I work for a mid-sized commercial contractor in central Ohio. At my peak, I was pulling in around $78,000 a year. Solid middle-class income, nothing flashy, but enough. My wife Dana works part-time as a dental assistant, about $22,000 a year. We have 2 kids, Tyler, who's 16, and our daughter Keely, who just turned 12. For most of the 2010s, we were fine. Not saving enough, not investing smart, but fine. We bought our house in 2014, a 4-bedroom colonial in a suburb outside Columbus. Purchase price, $289,000. We put 5% down. The mortgage was $2,147 a month, including taxes and insurance. That was manageable, until it wasn't. Here's where everything started cracking. In 2021, the construction company I worked for lost 3 major contracts back to back. Supply chain issues, material costs doubling, 2 clients pulling out entirely. My hours got cut. I went from a salaried foreman position to hourly. My income dropped almost overnight from $78,000 a year to right around $51,000. We didn't adjust fast enough. That's the honest truth. We kept living like we were still a $100,000 household. I told myself it was temporary. I told Dana it was temporary. The credit cards started filling in the gaps. We had 3 cards at the time. A Chase Sapphire with a $12,000 limit. We maxed it. A Capital One card with a $9,500 limit. We maxed it. A Home Depot card we'd used for a kitchen remodel. $6,200 balance. Total credit card debt, $27,700. Then, in March 2022, I threw my back out on a job site, L4, L5 disc herniation. I was out for 11 weeks. Workers' comp covered about 67% of my pay during that time, which sounds okay until you realize that 67% of an already reduced income barely covers groceries and utilities, let alone a $2,147 mortgage. The medical bills from my back surgery, yes, it got bad enough to need surgery, came to $19,400 after insurance. My out-of-pocket maximum had already been hit, but there were facility fees, anesthesiologist fees, a physical therapy copay situation that spiraled. $19,400 in medical debt on top of everything else. We also had 2 car payments. My work truck, $487 a month, $14,200 remaining. Dana's Honda, $341 a month, $9,800 remaining. So let me give you the full picture. Mortgage, $289,000 original balance, 4 payments missed, $11 and $388 past due. Credit cards, $27,700. Medical bills, $19,400. Auto loans, $24,000 combined. Total debt load, just over $361,000, with an income that had dropped by a third and a credit score that was already starting to slide. And the foreclosure notice was sitting on my kitchen table. Section 3. Emotional crisis. 4 Sudanosi 7:30. I want to tell you what those months actually felt like because the numbers alone don't capture it. The collection calls started in January. Medical billing companies, the credit card servicers. At one point, I was getting 11, 12 calls a day. I'd be on a job site, gloves on, and my phone would be buzzing in my vest pocket every 20 minutes. Unknown numbers. 1-800 numbers. Numbers that looked local but weren't. I stopped answering. That was a mistake I'll talk about in a minute. At home, Dana knew things were tight, but she didn't know how tight. I had started intercepting the mail. I know how that sounds. I'm not proud of it. But every morning, I'd get up before her, go to the mailbox, pull out anything that looked like a bill or a notice, and I'd stuff it in the glove compartment of my truck. There were nights I'd sit in the driveway at 11 p.m., just sitting there, because going inside meant facing everything. Tyler would knock on my truck window sometimes. "Dad, dinner's been ready for an hour." And I'd say I was just finishing a call. I wasn't finishing a call. I was falling apart quietly, by myself, in a pickup truck in my own driveway. The breaking point was a Thursday evening in late February. Dana was folding laundry, and she found a letter I'd accidentally left on the washing machine. It was the formal notice of default from the mortgage servicer, the first official step in the foreclosure process. In Ohio, that's the beginning of a legal timeline. Once that clock starts, you have a limited window to respond before it escalates to a sheriff's sale. She read it. She didn't yell. That was somehow worse. She just looked at me and said, "Marcus, how long has this been going on?" And I sat down at the kitchen table and told her everything: the credit cards, the medical bills, the calls I'd been ignoring, the mail in the glove compartment. She cried. I cried. Tyler was upstairs doing homework. Keely was asleep. Dana said, "Why didn't you tell me? We could have figured this out together." And I didn't have a good answer. I think I was so ashamed. I'm the guy who's supposed to have it together. 17 years in construction, I built things, I held things up, and my own house was about to be taken. That shame will eat you alive if you let it. Section 4. Wrong choices, 7:30 to 10 ibn sound. Before that Thursday night, I had already tried a few things on my own, and I want to talk about them honestly because I see other people making the same mistakes. Mistake 1. Payday loans. Back in November, when I first realized I was going to miss a mortgage payment, I took out a payday loan, $7,500, to try to patch the gap. The fee on that loan was $225 for 2 weeks. I couldn't pay it back in 2 weeks. I rolled it over. Then again. By the time I finally paid it off, that $1,500 had cost me nearly $600 in fees. I was poorer than when I started. Mistake 2. Balance transfers. I got an offer in the mail for a 0% balance transfer card. I thought I was being smart. I transferred $8,000 from my Chase card to this new card, but I didn't read the fine print carefully enough. The 0% period was only 12 months, and the transfer fee was 4%, which was $320 right off the top. And I never made a dent in the principal during that year because I was using every available dollar to try to keep the mortgage afloat. When the promotional period ended, the rate jumped to 24.99%. I'd made my situation worse. Mistake 3. Ignoring the collection calls. This one had real consequences. When you stop communicating with creditors and collection agencies, they don't stop. They escalate. 2 of my accounts were sold to third-party debt collectors. One of them, for a $4,800 medical bill, actually filed suit against me in county court. I got a summons. I didn't respond to that either because I didn't understand what it meant. They got a default judgment against me. That judgment went on my credit report and allowed them to pursue wage garnishment. My FICO score, which had been around 680 before all this started, not great, but workable, had dropped to 511 by the time Dana found that foreclosure letter. A 511 credit score closes a lot of doors. Mistake 4. Raiding the 401k. In December, I took an early withdrawal from my 401k, $12,000, thinking I could use it to catch up on the mortgage. What I didn't fully account for was the 10% early withdrawal penalty plus the income taxes I'd owe on that money. I ended up with about $8,400 after the dust settled. I used it to make 2 mortgage payments. But I now had a potential IRS debt situation developing because I hadn't set aside enough for the tax hit. The IRS doesn't forget. and a tax debt can escalate in ways that make everything else worse. Section 5. Turning Point, 10-12. The Friday after Dana found the letter, she made an appointment. She didn't ask me, she just did it. She called a nonprofit credit counseling agency she found through the NFCC directory, the National Foundation for Credit Counseling. They had a certified counselor available for a free initial consultation. I didn't want to go. I felt like walking into that office meant admitting total failure. We went anyway. The counselor's name was Patricia. She was calm and completely matter-of-fact. No judgment, no theatrics. She'd seen situations like ours hundreds of times. She sat across from us with a legal pad and asked us to walk through every debt. When we finished, she didn't look panicked. She looked like she was solving a puzzle. She explained that we had a few legitimate options, and she was going to walk us through each one so we could make an informed decision, with the help of a licensed attorney if it came to that. Option 1 was a mortgage forbearance or loan modification request directly with our servicer. She explained that many homeowners don't know that banks often prefer to work out a modification rather than go through the expensive and time-consuming foreclosure process. She told us to contact our servicer immediately, not to ignore it, and ask specifically about a loan modification under their hardship program. This would not have fixed the credit card or medical debt, but it could stop the foreclosure clock. Option 2 was Chapter 13 bankruptcy, what's sometimes called the reorganization bankruptcy. Unlike Chapter 7 bankruptcy, which liquidates assets to discharge debt, Chapter 13 allows you to keep your home while you repay debts through a structured 3 to 5 year court-approved plan. Critically, filing Chapter 13 triggers what's called an automatic stay, which immediately halts foreclosure proceedings. She was careful to say that we'd need to consult a licensed bankruptcy attorney to determine if we qualified and whether it was the right path. Option 3 was debt consolidation for the unsecured debts, the credit cards and medical bills, while handling the mortgage separately. This wouldn't stop a foreclosure on its own, but it could free up monthly cash flow. Patricia also flagged the 401k tax situation and strongly recommended we speak with a tax professional about the IRS implications before that became its own emergency. The worst thing you can do right now, she said, is nothing. That sentence hit me harder than anything else in that meeting. Section 6. Educational info. 12-13-15. I want to pause here and break down what Patricia explained to us because I think a lot of people in our situation don't actually know these options exist. Chapter 7. Bankruptcy discharges most unsecured debt, credit cards, medical bills, personal loans. It's faster, usually wrapping up in 3 or 6 months. But here's the catch for homeowners. If you can't get current on your mortgage, Chapter 7. A loan won't save your house. It might discharge other debts and free up cash, but the mortgage lender can still move forward with foreclosure once the automatic stay lifts. Chapter 13. Bankruptcy is different. It lets you catch up on missed mortgage payments over the life of your repayment plan while keeping your home. If you have regular income, which I did because I was back to work by this point, you may qualify. The impact on your FICO score is serious either way, but a Chapter 13 stays on your credit report for 7 years versus 10 years for Chapter 7. Debt consolidation through a nonprofit credit counseling agency, called a debt management plan, can reduce your interest rates on credit cards significantly and combine multiple payments into one. It doesn't help with secured debts like mortgages or car loans, but it can stop the credit card bleeding. Debt settlement, where a company negotiates to pay less than you owe, carries real risks. It can result in a significant credit score hit, and forgiven debt may be treated as taxable income by the IRS. Be extremely cautious and always consult a licensed professional before pursuing this route. And that's the thing I want to be clear about. Every situation is different. What worked for us may not be right for you. Please consult a licensed bankruptcy attorney, a certified credit counselor, or a qualified financial professional before making any of these decisions. These are legal and financial choices with long-term consequences. Section 7. Resolution. Treen, 15, 1430. Here's where we are now. We contacted our mortgage servicer the day after that credit counseling appointment. It was uncomfortable. It was humbling, but they assigned us to their loss mitigation department, and we applied for a loan modification. It took 6 weeks of paperwork and follow-up calls, but they approved a temporary modification that rolled our missed payments into the back of the loan and reduced our monthly payment by $310 for 12 months while we stabilized. We also consulted a bankruptcy attorney. Just a consultation, which many attorneys offer for free or low cost. She reviewed our full picture and told us that if the modification held and I maintained my income, we might be able to avoid bankruptcy entirely. But she also walked us through what Chapter 13 would look like as a backup plan, so we weren't going in blind. The collection agency that had filed a judgment against me. We're working with a consumer law attorney on that. There are legal options when judgments are obtained improperly or when collection agencies violate the Fair Debt Collection Practices Act. Our credit score is still damaged. I'm not going to pretend otherwise. But it's not 511 anymore. We're rebuilding slowly, and we're still in our house. Tyler is still doing homework upstairs. Keely is still sleeping in her room. I'm not sitting in my driveway at 11 p.m. anymore. I'm not going to tell you this story has a perfect ending because we're still in the middle of it. But I'll tell you this. The most important thing I did, the thing that actually moved the needle, was stopping the avoidance, stopping the silence, making the call. If you're looking at a foreclosure notice right now, or you're 3 months behind and terrified to open the mail, I need you to hear this. The clock is running whether you look at it or not. But there are people who know how to stop it, slow it, or at least give you options you didn't know you had. You don't have to have this figured out. You just have to make the next call. Section 8, CTA, 1430-1445. Get the free debt checklist in the description. Link below.